As of today, Monday, February 2nd, 2026, the market is currently active and GameStop is trading live at $25.26 per share. This represents a significant intraday climb of roughly 5.78% from the previous close of $23.88, as the stock tests a major resistance zone between $25.50 and $25.30. While most retail eyes are fixed on the flashing green numbers and the potential for a breakout above local highs, a much more subtle data point is surfacing in the company's recent filings that many investors are overlooking entirely. Ryan Cohen has moved beyond simple cost-cutting and has quietly positioned the company as a specialized financial vehicle that is increasingly looking more like a private equity fund than a traditional retailer. The surprising insight here is not just the $8.83 billion in cash and short-term investments, but the fact that interest income and investment returns are starting to rival the core retail operating income in terms of contribution to the bottom line. This shift effectively turns GameStop into a bet on Cohen's capital allocation skills rather than just a bet on physical game disc sales. The common market belief is that GameStop is a dying relic of a physical media world, struggling to find relevance as digital storefronts dominate the gaming industry. Many institutional analysts still hold a median price target well below the current trading range, viewing the company as overvalued on a fundamental basis and expecting a slow decline in net sales. However, the contrarian perspective that is currently driving price action is rooted in the aggressive transformation of the balance sheet. By closing hundreds of underperforming stores early in 2026 and leaning heavily into high-margin hobbyist categories like collectible trading cards and professional grading services, the company has managed to post a net income of $77.10 million for the most recent quarter. This is a massive 343% increase year over year that challenges the narrative of a terminal downward spiral. Institutional positioning is also showing a quiet shift. While some firms remain deeply skeptical, Michael Burry's Scion Asset Management recently revealed a long position, backing the cash-rich strategy and creating a psychological floor for the stock. Recent price action has been characterized by intense volatility and high volume, with today's share volume already exceeding 5.6 million in the first few hours of trading. Over the last week, we have seen a steady climb from the $21 level, fueled largely by a series of significant insider buys. In late January 2026, Ryan Cohen himself purchased an additional 1.5 million shares across 2 transactions, while directors Lawrence Cheng and Elaine Attal also added to their personal holdings. This cluster of insider buys is a powerful signal that the leadership believes the stock is undervalued, even at these levels, or perhaps they are aware of upcoming catalysts that the broader market hasn't fully priced in yet. Broader macroeconomic forces are also playing a role. As the US dollar fluctuates and interest rates remain a point of contention for the Federal Reserve, GameStop's massive cash pile acts as a unique hedge, earning substantial interest while other small-cap companies struggle with debt servicing. Short selling remains a central pillar of the GameStop story, though the dynamics have shifted since the historic events of years past. Current short interest is estimated at approximately 10 to 12% of the free float. While this is nowhere near the 100% plus level seen previously, it is still high enough to cause significant friction during upward moves. We have seen borrow rates for GME shares remain relatively stable at under 1% recently, indicating that it is not currently hard to borrow, which often emboldens short sellers to maintain their positions. Notable firms like Citron Research and various hedge funds have historically maintained a bearish stance on the stock, often citing a lack of a clear long-term digital strategy. The short thesis today is built on the idea that the retail business is still shrinking and that the current valuation is a bubble supported only by sentiment. Counterarguments point to the fact that the company has virtually no debt and enough cash to buy back its entire market cap or pivot into entirely new industries. Retail investors can monitor these trends through resources like FINRA short interest reports or specialized platforms that track fail-to-deliver data. A sudden spike in the borrow rate or a sharp decrease in available shares to short is often the first sign of a potential squeeze, but investors should be wary of chasing parabolic moves that lack fundamental support.
Sentiment on forums like Reddit and X remains cautiously bullish. The prevailing discussion has shifted from purely seeking a squeeze to analyzing the potential for long-term profitability. There is a lot of debate regarding the new compensation tranches for Ryan Cohen, which include options to buy 170 million shares at a strike price of $20.66 if certain market cap and EBITDA goals are met. This has led to some concerns among retail investors about future share dilution, as the company has a history of using share offerings to bolster its cash reserves. However, many see this as a necessary evil to build the war chest needed for a major acquisition. Comment how many shares you currently hold and what your take is on the rising short interest over the past 2 weeks. Do you think the current price reflects a fair valuation of the $8 billion cash pile, or is the market still underestimating the retail decline? At its core, GameStop Corp operates as a multi-channel retailer of video games, gaming consoles, and collectibles. The business model has historically relied on the high-margin used game trade-in market, but as gaming shifts toward digital subscriptions and direct downloads, that revenue stream has come under immense pressure. In response, the company has diversified into the collectibles market and expanded its e-commerce capabilities. Past performance shows a company that was on the brink of bankruptcy before a massive capital injection from retail-driven rallies allowed it to clear its debt and reorganize. Today, the company is divided into geographic segments across the United States, Canada, Australia, and Europe, with the US segment remaining the primary driver of both revenue and store closures, as the footprint is optimized for the digital age. Looking ahead, there are several possible scenarios. In a bullish outcome, GameStop uses its $8.8 billion cash reserve to acquire a high-growth technology or gaming company, successfully pivoting away from its reliance on physical retail. This would likely trigger a massive re-rating of the stock by institutional analysts who currently value it as a traditional retailer. A bearish scenario involves the company continuing to burn through its cash surplus while the retail business shrinks faster than cost-cutting can keep up with, eventually leading to a slow bleed of the share price back toward book value. Upcoming catalysts include the full-year earnings report and any potential announcement regarding the use of the cash stockpile. The expectation versus reality framework here is vital. The market expects a slow death, but the reality is a company that is currently more liquid and financially stable than almost any other mid-cap entity in the sector. To summarize, GameStop is no longer just a meme stock. It has evolved into a cash-heavy holding company with a shrinking retail footprint. The core of the current analysis is the tension between a declining legacy business and a massive untapped capital reserve. Insider buying from Ryan Cohen and his team suggests a high level of confidence in the next phase of the turnaround, while short sellers remain convinced that the retail endgame is inevitable. Investors should watch the $25 price level closely, as a sustained move above this resistance could signal the start of a new momentum phase. Understanding the borrow rates and institutional short positioning is crucial for anyone navigating this high volatility environment. The choice for investors is whether to trust the leadership's ability to deploy billions of dollars effectively or to stay sidelined until a clear new business model emerges from the shell of the old one. The reality of the situation is that GameStop has successfully navigated a period of extreme financial distress and has emerged with a balance sheet that is the envy of its peers. However, the clock is ticking on its retail operations, and the market will eventually demand to see more than just interest income on a cash pile. The gap between what investors think they know and what the data is actually showing is wider than ever. As long as the company maintains its current level of liquidity and insider alignment, it remains one of the most unique and unpredictable plays in the modern market. Whether the future holds a massive acquisition or a continued slow-motion pivot, the journey of GameStop is far from over. Would you like me to generate a similar deep dive script for AMC, or perhaps look into the short interest data for the broader retail sector?